welcome over another great video. Lots of confusion when it comes to jargon in the financial. We're going to cut through some of that today, going through a deep dive on RIFs, explaining all the nuances, starting with the big question, what is a RIF?
Yes, and if we want to define RIF in jargon, Registered Retirement Income Fund. That's what RIF stands for. So yes, a RIF is basically, it is designed for income. So unlike an RSP, which you're meant to accumulate, when you get to that, when you're saving, when you get to that RIF portion, basically what you're meant to do is withdraw some of the savings that you've used over a period of time to help with your retirement, which is a Registered Retirement Income Fund.
Yeah, and the tax, it's really a deferral.
Yes.
You don't pay anything on the investments, similar to an RSP, but when you take the money out, fully taxed.
Yes.
All the money in an RSP and in a RIF can be invested. You actually don't have to change the investments. So if you like the investments in the RSP, you can have the exact same ones in your RIF. No change required there. Main difference here between an RSP and a RIF, the main difference is a mandatory withdrawal. We'll explain that with some nuance in a moment, but that mandatory withdrawal from a RIF is really the key difference.
Yep.
So next frequently asked question, how do I convert my RSP to a RIF?
This is basically a simple question. It's basically just paperwork.
Forms.
I mean, theoretically, unless you want to change everything over, we are just changing mnemonics on the top, basically going from a Registered Retirement Savings Plan, or the RRSP, to the Registered Retirement Income Fund, or the RIF. And basically, everything can stay the same. It's just a matter of paperwork to convert it over so that the government now knows there must be a certain amount that must come out of this fund now, as opposed to the RRSP where you don't have to take anything out.
Yeah, so it's just paperwork.
Yep.
Bureaucracy is what it is. It's really quite easy. You move one from RSP to RIF.
Exactly.
When do you have to convert by? Well, that is by the end of the calendar year in which you turn 71. So if your birthday is in June, you don't have to do it by June on the birthday. You have until the end of that calendar year, so December 31st of the year in which you turn 71. Of course, you can convert early. Sometimes it makes sense to do that, to convert before 71, draw it down, but it's not optional after 71, December 31st of that calendar year. That's kind of the deadline to convert RSP to RIF.
And you don't have to take money the year you convert, but you do have to convert the year you're 71.
Yeah, the following year, you're going to have these withdrawal minimums kick in.
That's right.
And that's another common question. What are the withdrawal limits?
Yeah, and the withdrawal limits depend on when you take the money. So if you take the money early, it's a formula that's out there. And if you take it, well, it's the same thing as a formula after 71, but there's a certain percentage that goes on. So again, if you converted it early at, say, 65, they would want 4% of the entire amount of all your RIFs taken out. But if you do it at the 71 time frame, then you're looking at 5.28%. And those rates continue to go up each and every year.
Yeah, and that's set by the federal government. So this table that I created, the data is from Canada.ca. We're talking the minimum amount. We'll go through an example. We should mention there's no maximum amount.
Take it all out.
Yeah, if you got 100 grand and you're willing to pay the tax on that, you can take all of it out at once. The only catch is it's fully taxable.
Exactly.
So an example of how that minimum would work, let's say you turn 71 in 2024. So your birthday is some point in 2024. You have 100 grand in your RIF. Well, by the end of the calendar year, you're going to have to convert your RSP to a RIF. There'll be no mandatory withdrawal in 2024, but in 2025, these minimums we just described would kick in. You'd have that big table there, and what they'll look at is your age and the value of your RIF as of January 1st or December 31st.
That's right.
They're both holidays, markets aren't open.
Doesn't matter when.
Number. But regardless, they pick that number. What is the value and what is your age? So ideally, you're still probably going to be 2071 in 2025 on January 1st. That means your 100 grand, they're going to take 5.28% of that value. So $5,280 has to come out at some point in 2025. Now it's going to be taxed. The frequency of the withdrawals at all lump sum, is it going to be broken into monthly chunks? Is it done quarterly? That's all up to you. All the government is saying is you have to take that amount out at some point in 2025 and claim it as income.
Yeah, and then again, if you want to help with any of these calculations or what the percentages are, by all means, there's an easy way to try and find that. Contact us at chatwithclintonandkevin.com. We'd be more than happy to answer any of your RIF questions or how to convert or what you should be doing with it, things along that line or other financial plans. So you can go to our website, check out chatwithclintonandkevin.com. That's one way to do it. But other than that, I guess the biggest factor is how is this going to impact my taxes and what's going to go on? Well, the biggest factor is you're allowed to have all this money in your RSP and in your RIF, and it's all tax-free on its growth and anything else. But when you haul it out, it is listed as pure income to you. So if you take out 10 grand, that's 10,000 of income. If you take out 20, same sort of scenario. So it will have an impact on what your income is for the year, and you will get what's known as a T4 RIF at the end of the year describing exactly how much income you have to claim.
Yeah, most financial firms, they'll create and send out the T4 RIF in February, so in 2024. February 2025 is typically when you get your T4 RIF
That's
for
right.
the following year, so the 2024 tax year. It'll list on there all your withdrawals, any tax you've already paid,
Yep.
and that goes as part of your tax return. And now a little nuance here is the minimum. We talked about that big table and the minimum you have to take out. On that amount, on that minimum amount, you don't have to pay the tax up front.
No.
If you want, you have the option to say, give me the full value, and then when I file my tax return, I'll square up then. So to be very clear, it's not tax-free.
No,
You're just
not at all.
deferring and deciding when you will pay the tax. I'm not going to pay it immediately. I'll just add it to my return. I'll tackle it there. For any amount withdrawn from a RIF above the minimum. So in a prior example, the minimum was $5,280. If you say took $7,000 out, well, on that extra bit, the amount above $5,280, it's not optional.
No.
There's going to be withholding tax at source. They have to take it right off the hop. And then it's only that minimum where you get to make the decision. You can either pay the tax up front or you can pay it later when you file your return. So a little nuance there on the minimum. Also talking minimums.
Yes.
If you have multiple RIFs, let's say you have one at the bank, you have one at the credit union, you have one at a brokerage firm, you can't just say, well, across the board, I got 100 grand, so I have to take $5,280 out. Does not work that way.
Nope.
Each account is going to have its own minimum and its own forced withdrawal. So in that example, you would have to take money from the bank, from the credit union, and from the brokerage, which some folks are okay with. Some folks, that creates too much confusion, so they consolidate. You have to decide what's right for you, but that is how the rules work.
Yep.
It is per account that minimum applies.
And that will apply with everything. So the taxes are the same way. If you take just the minimum, there's no tax if you don't want it. If you take anything above the minimum at each institution, you're going to be taxed at each institution, which has to play it from there.
Yeah.
So that's a big factor to know. Now, a lot of people also want to know, how is this going to affect, my CPP and my OAS going forward? Well, if we're talking OAS, since OAS and the GIS are both income-based, the more you take out of your RIF, the higher your income. You may have this affect your OAS and your GIS because they are income-based scenarios. That is one that you really have to consider when you're deciding how much money do I want to draw out. As for CPP, though, that's a completely different situation.
Yeah, so the old age security, the guaranteed income supplement, those are income-tested benefits,
Yep.
which means the higher income you have, you could be losing some of those pensions.
That's
and
right.
RIFs do count as income. CPP, not the case. CPP is not income tested. You pay it into CPP, you get the money out. What you draw from your RIF won't impact the value you receive
At
from
all.
CPP. However, all of it is income. So CPP is taxed,
That's
your
right.
RIF withdrawal is taxed. So you may have to do some planning to make sure you don't get too high of a tax bracket there. But you won't lose any CPP because of a RIF
not at all.
withdrawal. So we went through a couple common questions there.
Yep.
A few tips as well. The first one being, for that minimum, you can use the age of your spouse.
Yeah, and this is an important one. If you want to start dealing with how you can reduce things, I mean, if you're typically 71 and you've converted it over, you're at that 5.28 percentage. But if your wife's 65, you can use her age, and then now you only have to take 4% out as opposed to that 5.28. So all of a sudden, you can save a whole bunch in the way of taxes because you're not taking as much out and putting it onto your income. So the age of your spouse is a very important one that you can use, assuming she's younger. If you were looking at somebody that's older, you may not want to do it that way.
If they're older than you, that defeats
So,
the purpose.
age of the spouse for where it is. That's one option.
Yeah, so as one tip, age of the spouse can lower your minimum withdrawal. A second tip is income splitting after the age of 65. 65 is a crucial number here. Money coming out of a RIF after 65 counts as pension income.
That's
which
right.
means it's eligible for income splitting. So if I take $10,000 out of my RIF and I'm 66, well, that could be split with my spouse. So $5,000 in my tax return, $5,000 in their tax return. That lowers the overall income. That could save you a bunch of tax.
Yep.
So income splitting, again, after 65 from a RIF, it does qualify for income splitting. That's an important tip.
Yeah, and then the final one that we'd probably want to take a look at is the pension income tax credit. Anytime after the age of 65, if you're taking money out of your RIF, that can apply to the income tax credit, which is a $2,000 non-refundable tax credit that you can use. So if you're taking the money out, all of a sudden I've got a taxable credit that I can go with. It's going to lower my taxes going forward. That may be something we want to take a look at as well.
Yeah, and many folks using this tip, maybe they're still working, they're 66, but they say, you know what, I may as well take $4,000 out of my RIF.
That's right.
I can split that, $2,000 for me, $2,000 for my spouse. We each get that tax credit.
Perfect.
So we're getting a little money out of the RIF and we're not paying a whole bunch of tax because we're using the credit. That is a strategy people do, and then maybe in their 70s when they actually need the money, they take out more, but they use this little tip to help get some out earlier while saving some tax. And that kind of leads into another video we have on the
That's
RRSP
right.
and RIF meltdown, which is combining all those strategies to really save tax on the RSP and RIF. If you like this video, or certainly like that video, it's on the screen now. Click on that one. We'll see you again very soon.
Take care.